Hello and welcome to Smartvalues podcast. If you want to know more about us, visit lamronanalysts.com. And if you would like to invest with us, do visit smartvalues.co.in. This podcast is for educational purposes only and should not be relied on for investment decisions. I'm your host Mamta Saraf, and we will be talking to our CIO, Mr. Soumitra Sengupta. Hello and welcome, Soumitra.
Thank you, Mamta. Great to be here.
Firstly, what are some of the difficulties people face when it comes to investing in the equity markets?
Well, before I address that question directly, I think we might want to step back and ask ourselves, why do people invest in, why do people need to invest in stock markets? The answer, as I'm sure most of your viewers would have heard many times over, is that investing in stocks generates returns that beat inflation and therefore conserves the value of your money. Keeping money in banks, even in fixed deposit, does not do this. Among the various asset classes that you can possibly invest in, stocks tend to be um, at the top, if not among the top of the whole pack. However attractive as it is, there are quite a few difficulties that people face. The stock market is a complex environment and is affected by many factors, which can be political and economic. Navigating through this environment is not easy. There is also an element of volatility that many find very, very difficult to navigate. All this maze of news and events makes the whole process bewildering.
Yes, I guess so. So, is choosing managers or mutual funds as difficult or less difficult than stock picking?
Well, I think choosing managers or mutual funds is less difficult than stock picking. For one, the number of mutual funds and managers are less than the number of stocks. Secondly, what is called the variation of outcome is less for managers and mutual funds than it is for stocks. Because the variation of outcome is less, the uncertainty level is also less, and therefore it will be easier to select managers than stocks.
All right. So, in that case, how does one go about finding a good manager?
Well, the first and most important criteria is the length of the track record. It is safe to presume that longer the track record of a manager, the better his performance will be in the future. This is also because a long track record means that the manager has gone through many cycles of ups and downs in the markets and has been able to withstand them. The second criteria would be performance. However, the performance has to be segmented into two categories. Firstly, it needs to be segmented in terms of market phases so that the performance in both bull markets and bear markets are viewed in isolation. There are many managers who perform differently in different market phases. What you need is a manager that does well in both phases. Now, let us pause for a moment and understand what the term well means. Manager's performance should not be viewed in absolute terms, but in relation to peers and more importantly, in relation to benchmarks.
Fine. So, the performance has to be looked at in relative terms.
Absolutely. Let me give an example here. If a manager has had a return of 40% in any period, but the market index has gone up 60%, then his performance, no doubt, very good in absolute terms, will be considered poor in relative terms. While selecting a manager, one has to always look at his performance in relative terms. What is the rationale here? Well, benchmark returns can be generated by anybody and does not require any skill. You can just go out and buy a bunch of stocks that mimics the benchmark. So in order for a manager's performance to cut any ice, it has to be better than the benchmark. The benchmark return is called beta in the finance literature.
Great. So, in effect, you're saying that beta means that is the index return is available to everyone. There is really no skill required, right?
Yes, it is available to everyone.
That's decent. And how is outperformance or alpha generated?
Well, we've already defined beta. We now need to define alpha. Alpha is the return generated by a manager over and above the benchmark return. Now, alpha can be positive and it can be negative. In the example that we just discussed, the manager performance was 40%, but the market index had gone up 60%. In that case, there was a negative alpha of 20%. In case the manager performance is better than the index, then the difference is the alpha.
So is manager performance consistent or does it fluctuate?
It is very unusual or even unlikely for manager performance to be consistent over a long period of time. In every manager's record, even the best ones, there will be periods of underperformance and even the occasional losing year. That is a given. What needs to be looked at is how quickly he recovers from these losses. Does he stay true to his style during periods of losses and underperformance? A manager who has a long term record that includes periods of underperformance would usually be better choice than a manager who has a short and spectacular record.
I see. So is alpha enough to assess a manager's performance?
Well, alpha is a good measure to assess a manager's performance. That is because it allows the performance to be segregated into two components, only one of which relies on the manager's skill. The part of the performance that is due to the market performance is eliminated from the evaluation of the manager's performance. However, by itself, alpha is not a complete measure, and other metrics also need to be considered. Overall, while alpha can be a useful metric for evaluating investment purposes, it should not be used in isolation. Investors should also consider other metrics such as beta, standard deviation, and Sharpe ratio to gain a more complete picture of the investments and the risk adjusted performance.
Okay, that's satisfactory. Then how does one understand how much risk a manager is taking?
Well, you have to look at the manager's performance and look at the investment returns and compare it to its risk with the expectation that a greater degree of risk is supposed to be compensated by a higher expected returns. Risk or the probability of a loss can be measured using statistical tools that are historical predictors of investment risk and volatility. Commonly used risk management techniques include standard deviation, Sharpe ratio, and beta. Value at risk and other variations not only quantify a potential impact but assess confidence intervals of the likelihood of an outcome. Risk analysis also has to oversee systematic risk and unsystematic risk, the two broad types of risks impacting all investments. So there are many ways in which investment risk can be looked at, and we need to take a holistic view of risk, and that is essential for us to understand how much risk a manager is taking.
Great. Thank you, Soumitra, for the neat insights into alpha and beta investing. I'm sure listeners would benefit to a great extent having learned about the same. Thank you once again.
Thank you, Mamta.